Did you know a single day in history saw markets lose nearly $1 trillion in value overnight? What if the greatest threats to your wealth are hidden in plain sight, repeating again and again, yet each time surprising even the experts? The markets crashed in 1929, again in 2008, once more in the dot-com era, and even recently during COVID. But what if I told you every single crash had the same warning signs hiding in plain sight? Today, I'll show you exactly how history repeats itself, and how understanding these patterns might just save your financial future. The Roaring Twenties, jazz music echoed in speakeasies, Ford's Model T dominated roads, and prosperity seemed unstoppable. Wall Street became America's new frontier. Speculation surged, with everyone, from shoeshine boys to bankers, investing heavily, often borrowed money, in a booming stock market. At its peak, the Dow Jones hit an all-time high, creating an illusion of infinite growth. But beneath the glamour, key figures like economist Roger Babson warned of speculative madness. He famously predicted disaster, but few listened. Markets were believed invincible. As confidence soared, signs of instability quietly emerged. Companies overextended, credit expanded recklessly, and stocks became dangerously overpriced. Investors ignored these signals. The stage was set for disaster, but optimism blinded everyone. Even the powerful investor Joseph Kennedy, sensing danger, exited the market quietly, a telling sign unnoticed by most. Kennedy sensed it. Babson warned about it. But how exactly did the greatest crash in history unfold in a single catastrophic week? October 29, 1929, Black Tuesday. Imagine Wall Street, bustling, suddenly turning deathly silent. Trading floors echoed with panic as brokers shouted sell orders. Stocks plummeted so rapidly, ticker tape machines lagged by hours. Fortunes evaporated. Bankers stared helplessly as billions disappeared. Crowds gathered outside the exchange, stunned into silence. In a single day, investors lost over $14 billion, today's equivalent of hundreds of billions, wiping out personal savings, retirement plans, and financial dreams. But was 1929 just a one-time event, or a warning signal that markets would ignore repeatedly? The Great Depression followed swiftly. Thousands of banks collapsed, millions lost jobs, breadlines formed nationwide. Emotional and financial devastation consumed families. Wealth vanished overnight. Government interventions were limited and delayed, worsening the suffering. It was an economic and psychological trauma that reshaped American life. This crisis changed investing forever, birthing massive financial reforms, such as the SEC designed to prevent similar collapses. Regulations emerged, yet as markets recovered, memories faded, setting the stage for the next crisis, again unnoticed. Fast forward decades later, technology took center stage, optimism soared, yet the exact same mistakes quietly returned, this time through an entirely new frontier, the Internet. In the late 90s, the Internet exploded onto the scene, transforming how people around the globe communicated, accessed information, and conducted business. This rapid expansion marked the beginning of a new digital era. Companies like Pets.com skyrocketed without profits, purely on hype. These businesses gained massive attention and investment based solely on the excitement surrounding the internet boom, rather than sustainable financial performance. Investors flooded the market, buying anything with "com" in its name. This frenzy created a speculative bubble as the focus shifted from actual business value to the mere presence of an internet domain. Wall Street celebrated the unprecedented surge in internet-based companies. The financial sector was exhilarated by the high valuations and the potential for rapid growth brought about by the digital revolution. But familiar shadows appeared again: overvaluation, speculation, and a reckless disregard for fundamentals. These issues began to undermine the sustainability of the market surge, hinting at an impending correction. As Nasdaq peaked in March 2000, greed blinded investors. Even seasoned investors ignored clear signs. Companies with no earnings traded at insane valuations. But euphoria overrode rationality. Skeptics were mocked, optimism ruled, and investors believed they were unstoppable. Then, reality struck. March 2000, stocks crashed. Tech giants like Cisco dropped dramatically. Companies evaporated overnight. Investors watched fortunes vanish. Nasdaq plunged 78%, decimating retirement funds and savings accounts. The dot-com bubble burst spectacularly, once again leaving stunned silence in its wake. Have you ever invested based purely on hype or ignored fundamentals? Think back, because this cycle isn't done yet. Thousands of companies failed. Jobs evaporated. Silicon Valley fell silent. Investors reeled from massive financial losses. Panic spread, eerily reminiscent of 1929. Yet again, the market taught a brutal lesson in speculation and greed. But the worst wasn't yet behind investors. Just 8 years later, another catastrophic event would shake markets globally, this time involving the very foundation of the economy itself. The early 2000s felt like a financial golden age. Homeownership soared to unprecedented levels, driven by banks offering mortgages to virtually anyone, even if they had no real means of repayment. Financial giants like Lehman Brothers, Bear Stearns, and Merrill Lynch thrived by repackaging these risky home loans into complex securities. Wall Street executives grew wealthier by the day, confident that housing markets could only go up. Financial titans reassured investors constantly, housing prices have never fallen nationwide, ever. Greed combined with arrogance created a lethal blind spot in America's economy. Despite appearances, whispers emerged. Economists like Nouriel Roubini and investors like Michael Burry tried desperately to raise the alarm. Housing prices inflated at unprecedented rates, doubling or even tripling in some areas within just a few years. Yet the banks ignored clear red flags, blinded by profits, even as defaults quietly surged. In boardrooms across Wall Street, executives chose to overlook warnings, burying toxic assets deeper within complex financial products. Even regulators were largely asleep at the wheel. The ticking time bomb grew louder, unnoticed beneath a blanket of complacency and greed. While Wall Street celebrated, the clock counted down. Few realized America's entire financial system was about to face its greatest test since the Great Depression. September 15, 2008. Lehman Brothers, a financial giant with over 150 years of history, suddenly filed for bankruptcy, the largest collapse in American history. On Wall Street trading floors, brokers stood stunned. Employees cleared their desks, clutching cardboard boxes filled with family photos and career memorabilia, unsure of their future. Immediately, panic spread through global markets. The Dow Jones plummeted over 500 points in a single day, the biggest drop since 9/11. Bank stocks fell like dominoes, one after another, their value disintegrating before investors' eyes. Americans watched on television as anchors reported dire news in somber voices. Suddenly, subprime mortgages and toxic assets became household terms. Stock exchanges around the world froze in horror as investors desperately attempted to salvage savings, pensions, and retirement funds. Millions of ordinary families across America, Europe, and Asia woke up to find years, even decades of savings wiped away overnight. But why were banks allowed to fail so catastrophically, despite the supposed lessons of 1929? The immediate aftermath was catastrophic. Credit markets froze solid, banks stopped lending, even to each other. Businesses, unable to secure loans, began mass layoffs. Families lost homes overnight. Foreclosure signs lined suburban streets like tombstones marking lost dreams. Emotionally, the toll was devastating. Depression rates skyrocketed. Marriages collapsed under financial strain. Protesters marched, outraged by billion-dollar bailouts for banks deemed too big to fail. Public trust in institutions vanished nearly overnight. The 2008 crisis reshaped financial policy worldwide. Sweeping regulations emerged. The Dodd-Frank Act in America aimed at curbing reckless speculation. Banks faced stringent stress tests. Global markets changed forever, becoming more cautious and tightly regulated. Homeownership dreams shifted radically. Banks became cautious lenders, and trust took a decade to rebuild. Yet again, as prosperity slowly returned, memories began to fade, lessons softened, and greed quietly crept back into financial markets, silently preparing the world for the next crash. Investors swore this would never happen again. Yet, only 12 short years later, a new crisis emerged, one that markets had never faced before. As 2020 dawned, markets were booming, hitting record highs. Investors confidently looked forward to another prosperous year. Yet quietly, halfway across the globe, a mysterious virus emerged in Wuhan, China. Initially, it seemed distant, easily dismissible as just another overseas news headline. Few imagined a tiny invisible pathogen could halt the global economy overnight. By February 2020, COVID-19 had spread globally. Italy entered total lockdown, sending shocking footage worldwide. Investors suddenly realized this wasn't an isolated problem. Panic surged quickly. Supply chains froze as factories shut doors. Travel halted abruptly. Wall Street traders nervously watched screens flash red, uncertainty rapidly spreading from boardrooms to Main Street. The speed of fear was unprecedented. Within days, cities worldwide emptied. Grocery shelves turned bare overnight. Images of empty streets flooded social media. This wasn't just a financial issue. Humanity faced an unknown, invisible enemy, and uncertainty fed investor panic at an alarming rate. What happens when an economy built on certainty encounters a crisis that no financial model could predict? March 9, 2020, Black Monday. The Dow Jones dropped over 2,000 points, its worst day since the 2008 crisis. Investors panicked as global lockdowns halted businesses everywhere. Restaurants, airlines, retail, all devastated overnight. Pension funds evaporated as people watched savings vanish in real time. Then, on March 16th, a week later, panic intensified. The Dow plunged nearly 3,000 points, its largest single-day drop ever recorded. Traders frantically called clients, trying desperately to calm nerves as portfolios collapsed. Retirement dreams shattered. Once again, scenes reminiscent of previous crashes repeated. Investors watched helplessly as the market crashed at a speed never seen before. Think back. Do you remember exactly what you were doing during that chaotic week in March 2020? Let me know your experience below. Governments acted swiftly and aggressively. Central banks worldwide printed trillions in stimulus. Emergency relief packages attempted to stabilize collapsing businesses and industries. Yet millions still lost jobs overnight. Restaurants closed permanently, family businesses shuttered, dreams extinguished. The psychological trauma was enormous. Anxiety surged as isolation and financial insecurity swept the globe. Markets slowly recovered due to massive stimulus, but uncertainty remained painfully high. Investors, burned yet again, questioned the stability of modern financial systems built on continuous growth. COVID permanently reshaped economies worldwide. Work from home became standard. Digital transformation accelerated dramatically. Stimulus led to unintended long-term effects. Massive inflation disrupted labor markets, housing bubbles, and supply chain chaos that persisted for years afterward. Investor behavior changed. Retail investors flooded markets through apps like Robinhood, dramatically altering market dynamics. Markets recovered faster than expected, creating dangerous complacency again. Yet beneath recovery, lessons lingered. Market stability is fragile, and black swan events, unpredictable yet catastrophic, are inevitable. Market crashes always carry harsh lessons. Overconfidence breeds recklessness, greed clouds judgment, and hidden risk always surfaces eventually. But how can you spot the next financial disaster before it strikes again? In my next video, I'm diving deeper, revealing exactly what experts believe could trigger the next market crash. Signs you can watch right now to protect your money. Click here to make sure you're prepared, because markets never crash the same way twice, but they always leave clues. Of all these market crashes, which impacted you or your family the most? Share your experience below. If this deep dive helped clarify financial history for you, make sure to subscribe to stay one step ahead, because history always repeats itself, and next time, you'll be ready.